Sudden, aggressive upside volatility in digital assets often appears chaotic, but these vertical moves rarely occur in isolation. In this instance, Bitcoin and Ethereum both experienced a synchronized price spike, breaking out of a narrow consolidation range within minutes. This movement was not limited to crypto exchanges. The same upward trajectory appeared simultaneously across legacy equities. Traditional indices like the S&P 500 recorded a 1.5 to 2% jump in post-market trading, perfectly mirroring the recovery in the digital asset markets. The exact timestamp of these moves makes the statistical probability of a coincidence near zero. A breakout of this scale is the result of a structural chain reaction involving legacy equities, specific chart geometry, and forced order execution. To understand these movements, an analyst must transition from predicting sentiment to deconstructing the mechanical flow of cross-market liquidity. The first domino in this chain reaction is an external shift in global macroeconomic or geopolitical risk. Specifically, rumors of a Middle East ceasefire and the reopening of the Strait of Hormuz acted as a catalyst, lowering risk premiums almost instantly. Institutional players and algorithmic trading desks immediately priced this shift into the market, even during low-volume post-market hours. This initiates a beta correlation cascade. Institutions treat assets like Bitcoin, Solana, and XRP as high beta proxies for traditional equities, instruments that amplify the moves of the broader market. Algorithms are programmed to track aggressive S&P 500 movements and execute mirrored orders across the 24/7 cryptocurrency order books. Because crypto markets have less overall liquidity than the S&P 500, the same relative influx of capital produces a more violent price swing. However, macro correlation only provides the initial spark. It cannot sustain a breakout on its own. A primed underlying technical structure must be in place for that spark to lead to a significant expansion. While geopolitical news dictates the timing of a move, the geometry of the chart dictates whether that move will result in a successful breakout. A market is technically primed when price action has consolidated to the point where new capital can be efficiently absorbed. The 4-hour timeframe provides the optimal lens for tracking this institutional liquidity flow. We start by mapping the primary support floor, currently established at the $60,000 level. The ceiling is defined by a dense area of historical resistance between $72,000 and $76,000. Breaching this resistance requires independent validation to ensure that buying pressure isn't already exhausted. The 4-hour Relative Strength Index, or RSI, serves as our primary tool for measuring this momentum. A recent pullback reset the RSI from an overbought condition back into neutral territory. This reset provides the mathematical space for fresh buying volume to build. This momentum reset often coincides with specific geometric structures in the price action. In this case, we see the formation of an inverse head and shoulders pattern within the consolidation channel. The completion of this pattern indicates that the sideways trend is failing and a new active trend is emerging. The setup is only valid if the price can successfully breach the initial $72,000 threshold. When an RSI reset aligns with a completed inverse head and shoulders, the technical confluence suggests that the market is structurally capable of testing the upper resistance zone. This leads to the final mechanical question. What happens to the order book when a macro-fueled candle actually touches that $72,000 resistance ceiling? To understand the reaction, we have to look at upside liquidity, the specific volume of resting orders clustered just above a resistance ceiling. Short sellers borrow an outset to sell it, betting the price will fall so they can buy it back at a lower price. To protect their capital, they place automated stop-loss orders just above known resistance levels. This lateral depth chart shows exactly where these defensive orders accumulate within the exchange. The $72,000 ceiling is reinforced by a dense cluster of stop losses waiting to be triggered. The mechanics of short selling require a trader to buy the asset back to exit their position. Consequently, the exchange processes a protective stop loss as a market buy order. When macro-driven correlation pushes the price even a fraction over the $72,000 line, the first layer of these orders is hit. As the price touches these defensive orders, they immediately flip from resting shorts to active market buy orders. This creates a feedback loop. Triggered stop losses force buying, which pushes the price higher, which triggers more stop losses. This cascade detaches price action from organic demand, driving the candle vertically through the liquidity zone. This structural liquidation is a short squeeze. The most aggressive price spikes are often driven by the forced purchasing of trapped bearish traders, rather than new investors. The life cycle of a market breakout follows a defined structural sequence. It begins with a macro trigger, which injects capital into high beta assets via correlation. That capital is absorbed by a technical structure, already primed for expansion by momentum resets. And the move is finalized by pushing into resistance, triggering the forced covering of short positions. This mechanical perspective differs from the standard approach of drawing static lines on a chart. Analysts do not guess the direction of a move. They identify where liquidity is trapped and determine what catalysts will release it. The market is a complex, interlocking machine. Mapping its internal mechanics is the only way to accurately quantify risk in a volatile environment.